Welcome to the deep dive. Today, we're tackling a really interesting question. How can we get a better handle on the U.S. stock market? Maybe achieve better returns without, getting completely overwhelmed by all the choices out there.
Right, and we're focusing today on a specific data-driven idea. It's called Ride the Right Horse, developed by Xietao Liu.
Ride the right horse. I like that. So it's a systematic approach designed for the U.S. market.
Exactly. It
Well,
blends momentum investing with portfolio optimization techniques. A pretty smart combination, actually.
Okay, and the core idea, the thing we really want to dig into is how understanding the market, specifically how returns are concentrated, and using a system like this, how that might lead you to better outcomes.
Yeah, and what's fascinating, and maybe a bit counterintuitive, is that market performance isn't always spread out evenly. Far from it, actually.
That concentration idea really jumped out at me too. Our sources, they point to something pretty significant here. Basically, the US market isn't this level playing field. We're talking about a concentration effect. A small number of stocks, the real top performers, they drive most of the gains. Think Nifty 50 back in the day or the Magnificent Seven more recently.
Yeah, those examples really nail it.
And get this, in 2023, some reports highlighted that just 10 stocks made up something like 75% of the MSCI US index's gains. 75%.
Wow. That's a powerful statistic, isn't it? It really hammers home the idea that finding and, well, sticking with those winning horses, as Lou puts it, could be incredibly important for returns.
So it's not just about picking any stock.
Not at all. There's research. Hendrik Bessenbender's work, for example, looking back decades, it shows most stocks actually underperform the market averages. So finding those few winners is key.
Which I guess leads us straight back to Lou's ride the right horse strategy. It's trying to systematically find these potential winners, right? But also manage the risks.
Precisely. It's about identifying them and being smart about how you hold them.
So how does it work? Can you walk us through the process? It runs daily, you said.
Yeah, it's a daily routine. It combines that trend-following idea with mean variance portfolio optimization. Step one is basically checking the market's temperature.
Okay, how does it do that?
It calculates something called market implied risk for all the stocks in the S&P 500 and NASDAQ Q100. Think of it as how risky the market itself seems to think each stock is right now.
So it's reading the room market-wise.
Sort of, yeah.
Yeah.
It also looks at the median risk across all those stocks and uses the SPY ETF as a kind of proxy for the overall market. And here's a key thing. If the broad market, the SPY, has had a negative excess return over the past year, the strategy basically says, hold on, maybe now is not the time for big bets. It suggests avoiding significant market positioning. It's like a built-in caution flag.
Okay, so if the general vibe is negative, it kind of pumps the brakes. Makes sense. What if the coast seems clear, though?
Right. If that main condition isn't flashing red, then it moves on to finding those potential winning horses.
Yeah.
It looks for momentum stocks.
Momentum. Stock's already moving up.
Yes, but with a specific condition they call Delta Market Zero. It's not just any upward movement. It's looking for stocks showing strong, you could say, accelerating momentum.
And how does it define that? What's a specific rule?
Well, there are two parts to it. A stock's short-term moving average, say the 5-day, needs to be higher than its last price. And that same short-term average also needs to be higher than its longer-term moving average, like the 30-day.
Okay, wait. Short-term average higher than the last price. Wouldn't that mean the price has dipped slightly below the recent trend?
Good catch. Let me recheck that detail from the source. Apologies, I misspoke slightly there, based on the notes. Let me clarify the momentum definition from Lou's paper. The condition is complex. It focuses on stocks where the market-implied risk-adjusted momentum is positive. The specific moving average comparison is actually part of the profit-taking rule later. For selecting stocks initially, it's about that positive delta market condition derived from risk and recent returns, forming a pool of candidates.
Okay, got it. So a pool of candidates based on positive risk-adjusted momentum. Then what? How does it pick from that pool?
That's where the portfolio optimization kicks in. Every day, it uses mean variance optimization. It's a mathematical way to build a portfolio.
Right, trying to get the best return for the risk you're taking.
Exactly. It doesn't just grab the highest momentum stocks. It looks at their expected returns and how much they tend to move up and down their variance or risk. It also considers how their prices move together. That's the covariance part.
Ah, so it avoids putting all its eggs in one basket, even if they're all momentum basket.
Precisely. It wants diversification within that momentum group. And to help with that, there's a cap. No single stock can be more than 10% of the portfolio.
Sensible. And how does it estimate those returns and risks?
It looks back at the historical price data, specifically the past year's worth of prices, to estimate the expected returns in that covariance matrix.
Okay, so it identifies candidates, then optimizes the mix daily based on recent history with a diversification cap. What's next? Buying the stocks.
Yep, execution. Once it knows the ideal percentage for each stock, it needs to figure out how many shares to actually buy or sell. It uses something called integer programming for this.
Integer programming? Sounds technical.
It just means it calculates the exact number of whole shares. You can't buy 0.7 shares considering the current prices and the total portfolio value. And crucially, it accounts for trading costs.
Oh, good. Because those can eat into returns, especially with daily adjustments.
They absolutely can. The strategy specifically factors in cost like a 0.4 basis points plus a small amount per share. Real-world stuff.
Okay. So it buys the optimized portfolio. Now, how long does it hold these stocks? Is there a sell rule?
Yes, there is. A profit-taking rule, or you could also see it as a loss-cutting rule sometimes. This is where those moving averages I mentioned earlier come back in. The rule is you only keep holding a stock if its last closing price is above its 5-day moving average, and that 5-day average is also above its 30-day moving average.
So it wants the price to be above the short-term trend and the short-term trend to be above the longer-term trend. If either of those breaks, it's potentially time to sell.
That's the logic. It's another layer of trend following, basically signaling if the upward momentum seems to be fading. Time to lock in gains, or maybe cut a position that's turning down.
It sounds very systematic, very rules-based. It feels like it's pulling together different established ideas, doesn't it?
It really does. The momentum part, the idea that winners tend to keep winning for a while, that's backed by quite a bit of academic research, people like Jagadish and Titman, Asness. They've studied this persistence.
Right.
And the portfolio optimization side. That goes straight back to Harry Markowitz and modern portfolio theory. Balancing risk and return, diversification.
Yeah.
That's foundational stuff.
So Lou's strategy is kind of taking these proven concepts and applying them in a very specific dynamic way. Daily adjustments, specific momentum filters, that risk overlay.
Exactly. It's trying to create this synergy, Use momentum to find the potential right horses, but use optimization and sell rules to manage the risk of riding them. Trying to get the upside while controlling the downside.
Okay, that makes a lot of sense conceptually. So we've got this daily process, check market risk, find momentum stocks, optimize the portfolio, execute trades cost effectively, and apply a sell rule. How did it actually do when they tested it? The research had backtesting, right?
Yes, and the results were, pretty interesting. They tested it from 2013 to 2024. Compared it against just buying and holding the SPY ETF, and also against an equal-weighted portfolio of the same universe of stocks.
Oh.
The backtest suggested the ride the right horse strategy delivered a higher compound annual growth rate, the CAGR. And importantly, it did so with a smaller maximum drawdown.
Max drawdown, that's the biggest peak to trough drop, right? So potentially less painful during downturns.
Potentially, yes. The Sharpe ratio, which measures return relative to risk, was also better for Lou's strategy in the tests. So the headline is, potential outperformance compared to the benchmarks, possibly with more stability.
That sounds like a good combination. Now, to really understand why it performed that way, they did an ablation study. What exactly is that?
Yeah, an ablation study is cool. It's like taking an engine apart piece by piece to see what each part actually does for performance. Here, they removed or tweaked specific components of the strategy one by one.
Like taking out that profit-taking rule we just discussed.
Exactly. They did that. And when they took out the profit-taking rule, guess what happened?
Let me guess. Higher returns, but maybe bigger drops.
Spot on. The KGR actually jumped significantly, up to around 22.8%. But the max drawdown also ballooned, up near 30%.
Ah, okay. So that rule really is acting like a safety brake. It costs you some potential upside, but it protects you quite a bit on the downside. It smooths the ride.
That's the insight, yeah. It's a trade-off. That rule seems key to achieving the lower volatility profile.
What else did they test? That diversification limit, the 10% cap.
They played with that too. They tried a stricter 5% cap per stock. What do you think happened there?
Safer, maybe. Lower returns, but also lower drawdown.
You got it. CGR dropped, but the drawdown also shrank quite a bit. Then they tried loosening it, allowing up to 25% in one stock.
More concentrated bets. I'd guess higher potential return, but much riskier, higher drawdown.
Precisely. The return went up compared to the 10% baseline, but the drawdown increased even more. So the study suggested that original 10% level was kind of a sweet spot.
Interesting. It shows how important getting that diversification level right can be. Not too much, not too little.
Definitely. They also looked at the risk parameter using the median risk versus fixed levels. Using the median, which adapts to the market, performs slightly better. It suggests that dynamic adjustment helps.
And transaction costs. Did the strategy fall apart if costs were higher?
Well, it held up okay under the assumed realistic costs, around 1 basis point per trade. The CAGR was still decent. But they found if costs got much higher, say up to 10 basis points, then yeah, the strategy didn't beat the SPY anymore.
Okay, so it's viable, but you need to be mindful of implementation costs. Can't trade excessively or with high fees.
Right. It highlights that practical execution matters.
So this ablation study, it really seems to confirm that the different parts, the momentum selection, the optimization, the profit rule, the diversification cap, they all work together. None is redundant. They each contribute something.
That's a good way to put it. It validates the design, showing how the components interact to produce the overall result seen in the main backtest.
Okay, so if we were to boil it down, what are the absolute key drivers making this strategy tick, according to the research?
I'd say number one, targeting those positive momentum stocks to tap into that concentration effect we talked about. Number two, the daily mean variance optimization to build a diversified portfolio from those stocks, balancing risk and return.
Okay.
Number three, those moving average filters, both for entry timing implicitly and explicitly for the profit-taking or loss-cutting. That's crucial for risk management. And maybe number four, that dynamic market risk assessment using the median, allowing it to adapt its posture a bit.
And what does this mean for, say, financial professionals or even really savvy individual investors listening? What are the potential takeaways or benefits here?
Well, first, it offers a clear, rules-based system that can be really valuable for taking emotion out of investment decisions. Second, the research suggests it's potentially implementable, considering those transaction costs and the use of integer programming for actual trades.
Right. It's not just theoretical.
Exactly. And third, that finding about potentially lower drawdowns compared to the benchmark, that could be really appealing to investors who are, more sensitive to risk or volatility.
So wrapping up our deep dive into Lu's Ride the Right Horse, it really throws a spotlight on that concentration phenomenon in the U.S. market, doesn't it? How a few stocks can carry so much weight.
It really does. And this strategy is presented as one systematic way you might try to capitalize on that, rather than just being passively exposed to it.
Combining that momentum focus to find the leaders with serious portfolio management and risk controls.
Exactly. Trying to get that balance right, aiming for the returns of the winners while actively managing the inherent risks. The backtesting and the ablation study seem to suggest it found a potentially effective balance, at least historically.
Definitely leaves you with something to chew on. Thinking about that concentration trend. How might that evolve? Will it continue? Will the winners change? And are there other systematic ways people could approach this kind of market?
Great questions. It makes you wonder, looking ahead, what the next winning horses might be and what kind of strategies will be best suited to finding and riding them. Food for thought.
Indeed. Thanks for digging into that with us today.